Alright everyone, what is up? Welcome back to the channel. Today we are diving headfirst into a topic that, let's be honest, can feel super overwhelming when you're just starting out investing. Specifically, we're going to be breaking down two of the most common ways people get their feet wet in the market: index funds and mutual funds. So, why are we talking about this? Because investing is one of the most powerful tools you have at your disposal to grow your money over time, beat inflation, and achieve your financial goals, whether that's buying a house, retiring early, or just having more financial freedom. But navigating the jargon and the sheer number of options out there can be a massive roadblock. My goal today is to slice through that confusion like a hot knife through butter, or maybe like a low-fee ETF through a high-fee mutual fund. We'll get to that. We're gonna lay it all out, plain and simple. By the end of this video, you'll have a crystal clear understanding of what index funds are, what traditional mutual funds offer, the key differences between them, and most importantly, you'll be in a much better position to decide which path might be the best fit for you as a beginner investor. So grab a coffee, maybe a notepad, and let's get into it. This is Index Funds versus Mutual Funds, the ultimate beginner's guide. Alright, so first up, let's talk about index funds. An index fund, in its simplest form, is a type of investment fund that's designed to mirror the performance of a specific market index. Think of an index like the S&P 500, which represents the 500 largest US companies, or the NASDAQ 100, which tracks the 100 largest non-financial companies on the NASDAQ exchange. Instead of having a highly paid fund manager trying to pick winning stocks, an index fund simply buys and holds all, or a representative sample, of the securities in the index it's tracking. This leads us to one of the biggest selling points of index funds: they are passively managed. Passive management means there's no active decision-making process happening day to day about which stocks to buy or sell beyond just keeping the fund aligned with its target index. The fund manager's job is essentially to replicate the index as closely and efficiently as possible. Why is this passive management such a huge deal? Two words: low fees. Because you're not paying for a team of analysts, a star fund manager's salary, and frequent trading costs, the expenses associated with index funds, often called the expense ratio, are typically incredibly low. We're talking fractions of a percent, like 0.03% or 0.05% per year in some cases. Over decades of investing, these seemingly small fee differences can amount to tens, even hundreds of thousands of dollars in your pocket, versus the fund company. Another fantastic benefit of index funds, especially for beginners, is instant diversification. When you buy a share of a broad market index fund, like one tracking the S&P 500, you're not just buying one company, you're instantly buying a tiny piece of 500 different companies across various sectors. This spreads out your risk. If one or two companies in that index have a bad year, it's cushioned by the performance of the other 498. This diversification is built right in. You don't have to go out and research hundreds of companies yourself to build a diversified portfolio. For a beginner, this is incredibly valuable. Index funds are often described as a set-it-and-forget-it type of investment. Because they passively track an index, you don't need to constantly monitor them, worry if your fund manager is making the right calls, or spend hours researching whether to switch funds. Historically, the performance of broad market index funds has been remarkably strong. In fact, study after study has shown that a majority of actively managed funds fail to outperform their benchmark indexes over long periods, especially after factoring in their higher fees. This means that by simply aiming to match the market with a low-cost index fund, you're often statistically more likely to end up with better net returns than if you tried to beat the market with a more expensive, actively managed option. For anyone looking to start their investing journey with a solid, reliable, and cost-effective strategy, index funds are, in my opinion, very hard to beat. Alright, now let's shift gears and talk about the other side of the coin: actively managed mutual funds. Actively managed mutual funds are overseen by professional managers aiming to beat the market. They research and make decisions on buying and selling investments. This expertise comes at a cost. Actively managed funds have higher fees than index funds. These fees can significantly impact your net returns. Most active managers do not consistently beat their benchmarks. Studies show many underperform the S&P 500 over time. Choosing a winning active fund is harder than picking an index fund. You need to research the manager's track record and strategy. In summary, actively managed funds offer potential outperformance but come with higher fees and more risk. So, there you have it. A pretty deep dive into index funds versus actively managed mutual funds. As you can see, index funds generally offer that low-cost, diversified, and simple approach, making them a fantastic option, especially for beginners or anyone who prefers a more hands-off strategy. On the other hand, actively managed mutual funds offer the potential for outperformance, driven by professional managers, but this often comes with higher fees and the challenge of picking a consistent winner, which history shows is incredibly difficult. The best choice really isn't a one-size-fits-all answer. It truly depends on your individual financial goals, your risk tolerance, how much time you want to dedicate to managing your investments, and frankly, your belief in whether active managers can consistently justify their higher costs. My hope is that this video has armed you with the foundational knowledge to make a more informed decision. Don't just take my word for it, or anyone else's for that matter. Do a little more digging, read up on specific funds you might be considering, and always pay attention to those expense ratios. They matter more than you think. Remember, investing is a marathon, not a sprint. The decisions you make today will shape your financial future. If you found this video helpful, please give it a thumbs up. Subscribe to our channel for more insightful content. Happy investing!